Hello and welcome everybody to another episode of Books and Bytes. Imagine a country pulling off an economic high-wire act, booming growth, and remarkably stable prices, especially compared to other developing nations at the time. Sounds like a miracle, right? But step back and you see something else below the wire. A mountain of bad debt, non-performing loans so huge they represented maybe half the country's economy. How do you possibly have both? We're diving into a book today that argues the key isn't just economics, but the messy, fascinating world of elite politics inside the Chinese Communist Party during the Reform era.
That's really the core puzzle this book zeroes in on.
Yeah.
It challenges that simple narrative of, a straightforward economic transition. Instead, it says these seemingly contradictory outcomes, rapid growth, relatively low inflation, and these massive NPLs, they're all products of the same fundamental force.
Which is?
The push and pull between different factions within the party leadership.
Okay, let's unpack this then. We'll explore the book's main arguments by looking at the source material you shared. First, how the banking system was designed less as like a commercial thing and more as a party tool. Then, the nature of these elite factions and how their competing incentives drove resource allocation. We'll look at how economic crises, especially inflation spikes, became these pivotal moments for political shifts that directly impacted financial policy.
Right. Crucial moments.
And finally, the long-term consequences, especially that persistent NPL problem created by this deeply intertwined political and financial system.
Exactly. And the book lays this out chronologically, which is helpful. It
Yeah.
shows how this dynamic played out through specific historical periods, specific events. We'll follow that path, to see the argument unfold.
Okay, great. So let's jump straight into what the book calls the not quite a miracle. What's the initial surprising picture it paints?
Well, it starts by highlighting that striking contrast you mentioned. Yes, China had spectacular growth. But remarkably, its bouts of high inflation were relatively short. The source notes they averaged about 7.5 months in China, compared to nearly 4 years, like 41 months in market economies during similar transitions.
Which, yeah, on the surface sounds like a huge policy success, pretty impressive control. But then you immediately hit the hidden cost, the darker side.
Exactly. The enormous pool of non-performing loans, NPLs.
Yeah.
We're talking about estimates around 50% of China's GDP back in 2001.
50%.
50%.
Yeah.
Think about that. Half the national output basically tied up in bad debt.
Wow. That is truly staggering. It's not just, a bad quarter for the banks. It's a fundamental structural issue.
It is, and as the book stresses, this isn't just an accounting problem. It's a massive drag on the economy's potential. All that capital deployed poorly, not generating productive returns.
So the puzzle deepens. If China was so adept at managing other parts of its economy, even reining in inflation relatively quickly, why did banking reform lag so dramatically? Why this NPL mountain? And the book's central claim is what? That the very same political forces that helped constrain inflation were also precisely what prevented true banking reform.
That's the crucial insight they want you to grasp. It wasn't a bug, it was a feature. The political logic that explains one outcome also explains the other. They're linked.
Which leads us right to the banking system itself. The book describes it as fundamentally a tool of the party, not really an independent financial sector.
That's spot on, yeah. The core of the system was dominated by just a few major state banks, the Big Four, consolidated back in the early 1980s. And these banks weren't set up primarily to, evaluate credit risk or lend commercially in the way we might think. Their main job was to serve state policy.
Yeah, so
By channeling funds to specific industries, supporting state-owned enterprises, SOEs, and financing major government projects, it was all part of the broader economic reform agenda.
And the main lever of control was supposed to be the central plan, right? The National Credit Plan.
Yes, that was the formal mechanism on paper. The plan dictated how much lending should happen, aiming to control the quantity of money, at national, provincial, even sectoral levels.
But the source material provides fascinating details showing how this planned control was consistently, overridden. It mentions loan expansion routinely exceeded targets.
Right. This is where the political reality starts to peek through the formal structure. Despite the plans, despite tools like reserve requirements, which, get this, the central bank often had to counteract by re-lending funds back to banks because they lent too much.
Wait, relending? So telling them to hold reserves but then giving them money anyway?
Right, defeats the purpose, doesn't it?
Yeah.
But yeah, actual lending consistently blew past the targets. The book highlights data showing that between 1991 and 1996, actual lending was nearly a third, 31.9%, above the targeted amount on average.
A third over target. Wow, That's not a slight miscalculation. That's clearly a system being driven by something else, something other than the stated plan. And interest rates weren't really used flexibly either.
Correct. Interest rates were largely fixed, hardly changing at all before the late 1990s. Only 4 fluctuations mentioned before then. So that reinforces the idea that control was about quantity, driven by political signals embedded in the plan, not by price adjustments like interest rates responding to market conditions.
And the party's control wasn't just through these plans. It was direct, personal control, embedded within the banks themselves.
Absolutely crucial point. You had the party committee system with direct oversight of key appointments within the banks, who gets the top jobs. And party disciplinary and inspection teams were stationed inside the financial institutions, a constant channel for political influence, ensuring loyalty.
So even after a restructuring in 1998 that tried to centralize appointments away from local governments, the source notes that informal political influence just persisted.
Right. Reforms could change the organizational chart, sure, but the underlying political networks, the pressures, they remain powerful. Informal channels still mattered.
Okay, so we have a banking system designed as a political tool, formally controlled by plans but consistently pushed off track by something. Now, let's get to the core of the book's argument. Factional politics. How does the book define these factions? It's not like political parties.
No, not at all like formal parties. The definition they use is key. They're personal networks. Networks of reciprocity centered around a patron figure. People in the network support the patron, and in exchange they get things like promotions, access to economic resources, policy influence. The ultimate goal, expanding the patron's power base.
So it's all about loyalty and mutual benefit within these elite networks. And the book identifies 2 main types relevant to the financial system.
Yes, 2 types with very different incentives, which is really important here. Generalist factions and technocratic factions. Generalist leaders are typically those who've risen through the ranks, often serving in the provinces, building these broad support networks. Technocratic leaders, on the other hand, are mostly based in the central government bureaucracy. They specialize in specific policy areas, finance, economics, that sort of thing.
And their incentives clash directly when it comes to the banks. How so?
Precisely. Generalist leaders, think about it, they have a strong incentive to channel loans to the provinces where their allies and protégés are in charge. More loans mean faster provincial growth, which makes their network members look good, boosts their promotion chances. The book even provides statistical evidence for this.
Really? Like what?
It shows a link, a positive correlation, between a provincial leader's ties to the party secretary general and higher local loan-to-deposit ratios in their province.
Interesting. So the banks basically become piggy banks for promoting their network's interests. What about the technocrats then? What's their angle?
Technocrats benefit from stability and central control. Their power, their reputation, it's tied to effective policy management, especially macroeconomic stability. Inflation is bad for them. They have much less incentive to channel funds provincially. Their focus is on national aggregates, maintaining order in their specific policy domain, like finance.
And this is where economic crises, particularly inflation, become these pivotal moments in the struggle between them.
Absolutely. Inflationary crises are the windows of opportunity for technocrats. Why? Because they often possess the most reliable economic data and analysis. And the generalists, fearing economic collapse might threaten their power too, grudgingly concede authority to the technocrats. They let them implement austerity measures, regain control. Temporarily.
It's like they delegate the unpopular work during an emergency. The book describes it as delegating monetary policy to a neutral technocratic faction. Why neutral?
Well, the argument is that once the technocrats centralize power and implement unpopular austerity, it's politically costly for any generalist faction to immediately reverse it, even the dominant one. It looks bad. And crucially, technocrats typically lack the broad political support base needed to actually challenge for ultimate power. They're seen as less of a long-term threat. So this relative lack of political ambition makes their temporary control more credible for bringing stability.
Got it. So the technocrats get a temporary leash during a fire, but the fundamental political pressures from the generalists are still simmering, just waiting for the fire to die down. Let's see how this dynamic played out then. The book uses the 1983-1986 period, what it calls the classic inflationary cycle, as a prime example. How did that unfold?
Okay, so this period started with the economy growing faster than planned, around 1982-83. Deng Xiaoping, seeing opportunity, signaled the desire for faster development. Basically a political green light for things to loosen up.
Which was immediately met with resistance from figures like Chen Yun, right?
Well,
Representing that more cautious, control-oriented, maybe technocratic view.
Exactly. Chen Yun pushed back hard against decentralization signals. He criticized Deng's designated successor, Hu Yaobang, for getting involved in finance, and he successfully established the Central Finance and Economic Leading Group, the CFLG, this high-level body designed to centralize policy coordination and strengthen central control over finance.
But the political maneuvering wasn't one-sided. Deng apparently blocked the widespread dissemination of Chen's critical remarks, signaling he wasn't giving up on his push for speed.
Right, it shows the push and pull. And other leaders, like Zhao Ziang, while maybe sympathetic to the provinces wanting more funds, were constrained by the prevailing central retrenchment policy during this phase. They had to toe the line somewhat.
Then came Deng's famous trip to the south in 1984. The source portrays this as a really decisive political signal.
Oh, it was a powerful cue. Deng's encouragement of local initiative, his praise for the special economic zones, it essentially collapsed the resistance from many central bureaucrats. Sensing the shift in political winds, local officials quickly responded. How? By pressuring the banks to dramatically increase lending.
And the predictable outcome of that politically driven lending spree, according to the book's dynamic.
High inflation. Yep, appearing about a year later. And this economic crisis then forced the generalist factions to, once again, concede power back to the technocrats to stabilize the economy. It's this boom-bust cycle driven by politics.
And critically, this is also the period where the MPL problem really began its significant accumulation, isn't it?
Precisely. That surge in politically directed lending, often for pretty reckless local projects, created a ton of bad debt. When the inevitable crackdown came to fight inflation, many of those projects just failed, leaving the banks holding the bag. The source mentions infamous examples like the Hainan car smuggling ring incident, which alone generated something like 3 billion yuan in NPLs. Crazy stuff. Banks weren't lending based on careful credit analysis. They were funding policy goals, subsidizing electronics companies, paying for agricultural procurement regardless of whether it made commercial sense.
Okay, moving into the next cycle discussed. 1987-1996. The book again highlights how inflationary expectations were explicitly driven by political signals, not just abstract money supply figures.
Yeah, this is a key piece of evidence for their argument that the government wasn't some unified actor making purely economic decisions. It was fragmented. After the previous crackdown, monetary policy loosened again in 1986, driven by new PBOC regulations designed specifically to support growth and liquidity, even though it's pretty clear this would lead to more lending and potentially inflation again.
And this period saw the rise of a very significant technocrat, Zhu Rongji.
Zhu Rongji. He became a champion of strengthening central macroeconomic control. He viewed these recurring inflationary cycles as direct evidence of weak central authority, something that needed fixing. He famously tackled the triangular debt crisis, where SOEs owed each other huge sums, often delaying payments to banks as well. Zhu injected a massive 80 billion yuan from the banks to clear over 380 billion in this interconnected debt. Administratively, it looked effective, sorting out the SOEs.
But crucially, this came at a huge cost to the banks themselves, didn't it?
Exactly. It dramatically increased state bank bad debt. The source says it jumped 42% in 1991 alone because of this intervention. So it illustrates that even powerful technocrats like Zhu, focused on stability, were still willing to use the banks as tools for state-mandated rescues. They actively undermined the idea of banks becoming truly commercial. Their priority was state control and SOE health, not necessarily banking efficiency.
And then, like clockwork, another powerful political signal pushing the other way, Deng's 1992 Southern Tour.
Yep, another catalyst. Deng's tour reignited decentralization pressures. It led to formal policies granting more autonomy and preferential treatment to special economic zones and provincial capitals, more fuel for local growth ambitions.
And Jiang Zemin, consolidating his power after 1989, also played into this dynamic, needing provincial support despite his base being more central.
Yes, the book suggests he sought to balance these forces. He leveraged his base in the central bureaucracy, but also needed provincial support. So he promoted regional development initiatives, like the Yangtze River Delta projects, the Pudong New Area in Shanghai. It shows how political strategies at the very top translated directly into directives that influence where capital flowed, often channeled through the state banks.
So we consistently see this pattern emerging from the analysis. Technocrats gain leverage during crises to centralize and stabilize, but as soon as the immediate heat is off, the political imperatives of the generalist factions push back, demanding decentralization and increased lending, often non-commercial, politically motivated lending.
It's a recurring core dynamic identified by the book, absolutely.
And this pattern continues into the next period covered, 1997-2006. This phase was marked by an unprecedented degree of financial centralization under Zhu Rongji, especially after the Asian financial crisis provided, well, another moment of leverage for stability advocates.
Yeah, the crisis certainly strengthened Zhu's hand. And this period, combined with a surplus economy, actually resulted in years of low or even negative inflation. A big shift. Local governments found it much harder to sort of strong-arm the banks for funds during this time. Yeah. Central control was tighter.
But despite controlling inflation and centralizing power, the underlying issue of using banks for state goals, particularly propping up SOEs, didn't just disappear, did it?
No, it definitely didn't disappear. It just took a different form, perhaps. Zhu's major focus during this time was getting SOEs out of difficulties, as the phrase went. And the banks remained the primary tool for this, directing capital heavily towards the state sector, even while the more dynamic private sector was often starved of funding.
And how did they try to tackle that massive NPL mountain that had accumulated by then?
The main strategy was basically to shift the burden off the bank's balance sheets and onto the government budget. They created these asset management companies, or AMCs. The idea was the AMCs would buy the bad loans from the banks. However, the Cliff's finding on actual cash recovery is pretty telling.
How telling?
Only about 11% of the NPLs transferred to the AMCs were actually recovered in cash by the end of 2005.
Only 11%. Wow, that's essentially just formalizing the loss, moving it around.
Pretty much. And to fund the AMCs in the first place, the central bank, the PBOC, had to extend massive re-loans. We saw that term before totaling 570 billion yuan. So the liability, in effect, was just moved to another part of the state balance sheet. It didn't vanish.
And the source points out that even the process of deciding which bad debts got written off wasn't purely an economic decision. It was politically influenced, too.
Yes, apparently it was often directed by agencies like the State Economic and Trade Commission, the SETC, essentially the body managing state industry, and these write-offs often favored large, politically connected SOEs. So even with new institutional structures like the AMCs, the process of managing the NPLs remained tied to political influence. The book also highlights the continued policy bias against the private sector during this time, including restrictions on private financial institutions and keeping interest rates low, which mainly subsidized borrowing for the big state conglomerates.
Then, predictably perhaps, toward the end of Jiang Zemin's term, leading up to the 2002 Party Congress, we see the political pendulum swing back again towards decentralization.
Following the familiar pattern, yes. As conditions stabilized and political transitions approached, the incentives for generalist factions to boost local growth and reward their networks resurfaced. The source notes a rapid increase in bank lending starting in early 2002, directly following Jiang's signals about promoting a well-off society and emphasizing regional development again. The PBOC regional branches apparently responded very quickly to these political cues.
And predictably, that surge in lending led to rising inflation again by 2004, and we even see continued signs of elite disputes over policy playing out, like Wen Jiabao's subsequent efforts to cool down the investment fever, including specific crackdowns like the T-Bin Steel case and directives from the new banking regulator, the CBRC.
The cycle, driven by those underlying factional dynamics, just continued to play out. The push and pull was ongoing.
So to bring it all together then, the book's core argument really synthesizes all these points. The seemingly contradictory outcomes, the fast growth, the relatively controlled inflation, and the enormous NPLs are fundamentally explained by this constant interplay, this factional struggle.
That's the key takeaway. The struggle between, on one side, the dominant generalist factions pushing for growth and promoting their protégés through decentralized, often politically directed credit, and on the other side, the technocratic factions who gain power during crises to impose centralized control and stability. That struggle is the engine that produced all of these results. It's not one or the other, it's the interaction.
Right. Economic crises give the technocrats a temporary moment of power, allowing them to rein in inflation relatively quickly compared to other places.
Right. But, and this is the crucial but, the underlying political pressures from the generalists don't disappear. As conditions improve, those pressures reassert themselves, and that leads to renewed cycles of decentralization and lending driven more by political connections than commercial logic, which inevitably feeds the NPL problem all over again.
And the book suggests this symbiotic relationship, even though it creates huge financial inefficiency, and this NPL burden actually contributes to political stability by balancing these powerful, competing elite interests.
It's presented as a kind of trade-off, yeah. It allows the various factions to pursue their goals within the system, preventing maybe bigger political cracks from forming. But the cost is a banking system that really struggles to allocate capital efficiently because it's fundamentally a tool of political power, not a commercial enterprise. That persistent NPL burden is the direct consequence of this political allocation of credit over decades.
It's a really compelling framework for understanding China's financial story, I have to say. One that puts political incentives front and center, rather than focusing purely on institutional design or, standard economic theory.
It certainly provides a powerful lens, a different way to view decades of China's economic development and its ongoing financial challenges.
So, armed with this understanding from the book, this deep dive into how elite political incentives, rather than purely economic logic or formal institutions, have historically shaped China's financial system and created its NPL burden. What does this suggest about the prospects for fundamental banking reform and sustainable financial stability in China going forward? Is the pattern destined to repeat? Or are there perhaps new dynamics at play today that might finally break this cycle? That's definitely a question for you, our listeners, to consider.
A critical one indeed.
Thank you for joining us on this deep dive into such a complex and important topic.